So, what is CAPM all about, especially vis-a-vis the slope, which is something that you're definitely going to see in your Introduction to Corporate Finance course. And this is one video of many in which I go over CAPM graph intuition. We all understand what CAPM is all about, but how does this translate to our graph and how does this translate to our linear functions? And that's exactly what we're going to cover now. This video goes through the slopes and how we can understand the slopes and make sense of it in real time. So as you can see on your screen, we're dealing with a whole lot of questions that are related to the slope of our CAPM lines, which includes the CML, which includes the CAL, and the SML. So we want to be able to make sense of these. We want to know how do they actually operate, and we're going to go through that based on different proofs that I've created. All right. So A says that the steeper the slope of the security market line, the higher the market risk premium. And this is really cool because we have a lot of good stuff in this question. We're discussing this concept of a steep slope. We're discussing this concept of the SML. And we're also introducing the higher the market risk premium. So we're discussing this concept of the market risk premium. Now, if you know your CAPM, if you know your good stuff, you know that we're dealing with the SML. And it's also painfully obvious that the market risk premium also deals with the SML. So with that, we just want to be able to understand, well, what is the slope of the SML? How can we distinguish the slope of the SML? What is it? What's its name? And also what happens if we have a steeper slope? Okay. So in this case, I think we could all agree that a steeper slope, okay, a steeper slope means a bigger M. Okay. So if your slope is steeper, that means that your M, i.e. your slope, is also bigger. It means, they're directly proportional. If you have a steeper slope, therefore your M will be higher, therefore your slope will be bigger, okay? And now we want to know, well, what is the slope of our SML? Is it actually the market risk premium? And what is the market risk premium? So if we go up on my proof, you will be able to see, as I said, that I wrote a very large note, very large set of notes that you could use to get a better understanding of what, the SML is all about and how can we see what the slope is. So if you could look on your screen, you clearly see that our slope is highlighted in green and it's as follows. All right, so it's ERM minus RF. Okay, and we know at the very bottom that this right here, our slope, is our market risk premium. Okay, and if you want a proof of why that's the case, you could see right here that because we know that our SML line follows a linear function, so because we know the SML line follows the same patterns as a linear function, we know that it's going to go through the form of y equals mx plus b. And we want to be able to see, well, how does that actually translate to our SML? Now, as you can see on your screen, I took the liberty to define our yx equals mx plus b and kind of substitute the different terms for what they are in respect to the SML. So as you can see on your screen, I took the liberty to showcase what are the different parallels that you could make between our linear function format to our SML. Now we know that our linear function is essentially written as y equals mx plus b. And we also know that our SML is written as follows, right? So with that being said, how can we see the different parallels here? So we know that y will be equal to ERP. So ERP also being our k in this case, the expected return of our scenario. Now, in this case, we know that m is equal to the slope, all right? M is equal to the slope, so in this case, the slope will be ERM minus RF. And we know that, as we can see, our horizontal axis consists of beta, therefore our x will be equal to beta. And then we know that b is our intercept, and in this case, we have made it very obvious that our intercept is equal to RF. Therefore, this is our intercept. That the steeper the slope of the security market line, the higher the market risk premium. Well then, yeah, for sure. If our market risk premium is our slope, and a steeper SML would just mean that we have a higher market risk premium. Therefore, in this case, the answer has to be true. Now, if we look at our next prompt, the steeper the slope of the CML, the higher the Sharpe ratio, well, now we only have to do the same gymnastic. We need to be able to define, well, what actually is the slope of our CML? And we can see that it's actually super duper close to our SML. Now, if we take a look at our CML, we quickly see that our function is equal to K is equal to RF plus ERM minus RF over the market risk times the market times our portfolio risk. And that's obvious because we know our horizontal axis is equal to risk, and we know our vertical axis is equal to the expected return. So in this case, because we know that y equals mx plus b follows the same format as our CML, it becomes very obvious to us that m will be equal to ERM minus RF over OM, over the market risk. So in this case, we also know that this is equal to our Sharpe ratio. Therefore, the steeper the slope, the higher the Sharpe ratio, which is actually true. Now, if we look at C, the steeper the slope of the security market line, the higher the beta of the stock. We know right now that our slope for SML is equal to the market risk premium. And if the market risk premium is equal to ERM minus RF, there's no way that a higher beta will be related to our slope. Right now, we know that our slope is equal to ERM minus RF, which is our market risk premium. Therefore, saying that we have a steeper slope would give us a higher beta is actually false. So we have D, which is actually a pretty interesting section of our question bank. We have the market risk premium is the slope of the security market line, which because we've done our proof, we know that that's totally true. And the difference between the expected rate of return from the market portfolio and the expected return of the risk-free rate. So essentially, this is a whole lot of text to tell you that ERM minus RF is equal to the market risk premium. That's exactly what they're saying, right? They're telling you, hey, we have the difference of ERM and RF, and we know that we're saying that that difference is equal to the market risk premium. Now, if we go back to our graph, that makes total sense to us because we know that we have these different parameters that are being set such that M has to be equal to our slope, and our slope in this case is equal to ERM minus RF. So in this scenario, this is true. Now we're giving you another prompt. This prompt saying that the slope of the capital market line is the market risk premium. Now, once again, we're introducing this idea of the CML versus the market risk premium, but we know that the CML has a slope that is the Sharpe ratio. And the Sharpe ratio is equal to ERM minus RF over risk M. I call it OM, but you know what I'm saying here, okay? So if we go back, we know that our CML will have the Sharpe ratio as its standard, as its slope. Therefore, in this case, if we tell you that the slope of the security market line will increase, if we tell you that the slope of the capital market line is a market risk premium, well, that's actually false. That wouldn't make sense at all. Now we have another prompt that's actually super interesting, and this one's a little bit more difficult, but if we look at our formulas and we look at our graph, we actually get to make sense of what's going on. So F tells you that the slope of the security market line will increase if the risk-free rate increases. Now, this is really interesting because we know that the slope of the SML is equal to the market risk premium, which is ERM minus the risk-free rate. So we're like, okay, well, we definitely know that if we have a risk-free rate within our slope, well, something's definitely going to happen to it. Something's definitely going to happen to our slope if something happens to the risk-free rate, RF. Well, let's see what happens, okay? So we have our slope. So we know that RF becomes bigger. Therefore, our slope will actually be smaller because as our RF gets bigger, as our slopes get smaller. We could take arbitrary numbers if you want. So if it was 10 our ERM and 6 was our RF, that would give us a slope of 4. But now if we're telling you that ERM is the same at 10 and that RF is now 7, well, we see clearly that our slope will be equal to 10 minus 7, which would be equal to 3. And 3 is smaller than 4. Therefore, We're telling you that the slope of the market line will increase if the risk-free rate increases. Well, that's actually false. If our risk-free rate increases, as we saw on our proof, we see that our slope actually decreases. They have an inverse relationship. If one goes up, the other goes down, and vice versa. All right. So G, last but not least, is saying that the market risk premium is only the percentage of the portfolio consisting of the risk-free assets divided by the percentage of the portfolio consisting of risky assets. And this is just a whole lot of talk because they're discussing this concept of the percentage, but we know that the SML slope is equal to the market risk premium and the market risk premium is equal simply to ERM minus RF. There are no percentages being discussed here. So it would be impossible for that to be the case. And this section, in this question, this would actually be false. So I hope this was able to help you out. I hope this gave you a better understanding of what the slope of our CML, CAL, and SML are all about. And if you look at the proof that was provided in the section in the description below, you'll be able to really see how everything actually works out. I wrote a whole lot of notes to really take your hand along the way to get a better understanding of what actually consists our CML, SML, and CAL. What we did here is we just looked at how we could ask you questions about the slope and how they actually relate to CAPM. So hopefully this helped, and I definitely suggest that you look at my other videos that discuss our intercept, values of our stocks, as well as the new efficient frontier. Hopefully this helped.